Right. Well, JP Morgan Chase and Wells Fargo kick off earnings season for the banks tomorrow morning. David Nicholas, president of Nicholas Wealth Management, joins us now with what to expect. So, fourth quarter earnings coming in for the banks. Are we going to hear about tax cuts and their impact, David?
Lauren, thanks for having me. Yeah, I think there's been a lot of optimism around tax cuts. I've been very bullish on financials over the last year. So I think with tax cuts, increased economic growth and higher interest rates, that all bodes well for financials. So I think we'll see JP Morgan come in around $1.70 share for earnings. Wells Fargo come in somewhere around $1.06. So we should beat expectations by a few cents.
Yeah, it's interesting. Both of those stocks, JP Morgan and Wells Fargo, hit all-time highs yesterday on the backs of, yes, a tax cut, which might create some noise, at least in the first round of earnings reports, but also higher interest rates, right? That bodes really well for financials.
It bodes really well, so we should see net interest margin increase. But look, even if we miss expectations a little bit, for investors, I think it's nothing to be concerned about. 2018 will be a great year for financials, and you're going to want to own, like you said, based on higher interest rates, higher investment banking activity. All that will bode well for financials next year.
I'm thinking of Wells Fargo as we look at this chart. Do you expect more consumers to try to refinance their mortgages, for instance, to combat higher rates?
Yeah, I think you'll see that activity take place early in the first quarter of 2018 with the expectation that interest rates will rise. So that's a positive for Wells Fargo. But for investors that are thinking about doing that, we should expect 4 interest rate hikes in 2018. So you want to do that earlier. So I think you'll see that priced in earlier in the year this year.
Talk about the bond market. Do you believe we're entering a bear market for bonds? The 10-year yield touched close to 2.6% yesterday. What's your thought on the bond market?
Yeah, you know, the bond market has had an amazing run over the last 30 years, and I'm here to tell us that bull market is over for bonds. We're going to enter into a bear market territory for bonds. Why? Well, we have interest rates rising, but the global demand, we saw China, a report come out and say that China may slow or stop bond buying here in the U.S. That is going to lead interest rate rises. I think investors that are depending on bonds for safety, they're going to get hurt. For every 1% rise in interest rates on a 10-year bond, that's about a 10% loss to the principal value of a bond. So I think the bear market for bonds is over. We're not going to see the safety in bonds like we've seen in the past. So I just think investors need to be very careful who are looking at bonds in an investment portfolio.
For a retiree, for instance, how should they position their investments?
Yeah, I mean, retirees are one of the largest holders of bonds. You want to look for investment classes that provide safety but don't have the interest rate risk. There's asset classes, guaranteed annuities can provide that, can be a great alternative to bonds inside of a retirement account.
All right. David Nicholas, thank you so much for joining us this morning.
Thanks for having me, Lauren.